Delta Airlines is trading around its 52-week low after reporting Q3 numbers, and the question on everyone's mind right now is how much lower are these airline stocks going to go? Is this the time to step in to buy? Will they ever reverse? As you can see here, the Jets ETF is down big as well. We'll answer all those questions on today's episode as we'll talk about Delta Airlines Q3 results. How's it going? Welcome to Everything Investing. I hope you're having a great day. In just a minute, we are going to go through all of the financials here that they posted just on their recent earnings results. We'll go through the top line, bottom line, balance sheet, cash flows, and finally we'll conclude with an evaluation of this business using our intrinsic value calculator seen on screen, which will identify whether or not Delta Airline is a value investment or not. As you can see, we do have some shaky numbers and growth metrics down here, but they do have a nice price to free cash flow ratio, which makes things all that more interesting, especially if we can start to grow from these levels. That being said, let's jump into our analysis. Okay, so here we have Delta Airlines Q3 results, and we'll start with the comments from the executives. All right, so they start off by saying that Delta delivered a strong September quarter with record quarterly revenues, okay, and double-digit operating margin, and that's because the travel recovery continues as consumer spend shifts to experiences and demand improves in corporate and international. All right, so as lockdowns have been revoked, people are actually going out more, seeing things, traveling more, and even businesses are taking part in all the action, which is definitely a bonus to Delta. Okay, and they go on to say that with strong demand and a return to best-in-class operational performance, they are ahead on their plan for the year on profitability and expect to be free cash flow positive, which is a big round of applause to them and something that's going to really intrigue investors and potential investors alike. They're working towards full network restoration by summer of 2023 and supports a meaningful step up in profitability and cash flow for next year as they look to earn around $7 of earnings per share and $4 billion in free cash flow by 2024. This is very important. We'll touch on that in just a moment. First, I wanted to talk about what they said about their revenues here, and that's that their unit revenues are up 23% compared to 2019 levels, marking the highest revenue and unit revenue quarter in Delta's history. Okay, and they're basically saying they're guiding for higher returns in the future, which is definitely also a good thing to see. So if their revenues are increasing, we should expect to see the same thing on their bottom line, at least somewhere down the line. We know that they are battling a lot of cost pressures right now. Fuel costs have been exponentially higher than usual, so all these things have had negative impacts on Delta, but at some point this will turn around. And if we look at this from a historical point of view, we can see they have been able to produce higher and higher revenues each year, obviously until 2019, and we know what happened then. The unfortunate part here is that their net income did not translate the same way, and obviously once again, once we got to 2019, we had some negative impacts. Can they get back to growth and start to see an upward trajectory here, especially in bottom line? That's what we're going to find out in just a second. First, let's look at what they're actually trying to do for the long-term vision of this business. As you can see, they're working on strengthening their trusted consumer brand, investing in the customer experience, restoring their financial performance, and they're looking to deliver mid-teens adjusted operating margins and over $7 of EPS by 2024, and then to generate strong cash flow, reduce the debt, and return to investment grade metrics. And then finally, they're looking to innovate further as they look to transcend the industry here and deliver financial outcomes that create significant long-term value. Okay, let's dive a little bit deeper here. Let's see how they've actually been transforming the business as is already. Look, from 2014 to 2019, they were already in the process of actually making some transitions here. As you can see, their premium products here made up about 24% of their revenues in 2014. By 2019, it made up of 32%. And when we compare that to the main cabin segment, this was at 56%, dropped down to 46%. They want this actually down to 39% as they look to increase their premium products and services here up to 36% of their revenues. The other transition they're making is that they want to improve on their other segment. Their other segment includes their loyalty programs, cargo, travel-related services, etc., which you can read about here if you pause the video. And the reason why they're making this transition from main cabin to premium services and products is because there's demand for these premium products, which underpins their strategy. As you can see here, there's higher profit margins in their premium cabin margin than there is with their main cabin margin, and that's the reason why they might as well focus on the businesses and the revenue segments that are producing them more profits in the long term, especially if there's demand for those products. Okay, so assuming that strategy does end up working for them, they'll be able to produce more cash flows, and with that cash flow, they can reduce the debt levels, which they have a target goal of $15 billion for. And they're also looking to reduce their net pension liabilities as well. And the thing is here, especially if they can generate stronger cash flows, reduce their debt levels, the stock is really going to appreciate from these levels. So it's kind of one of those things. You gotta have to wait and see how exactly is this going to turn out for Delta. As you can see, they make sure that you're aware they do have leading unit profitability. Okay, when we compare this to their other competition in terms of airlines, we can see they definitely have an edge over their competition. Okay, and another way that they're going to try to achieve their strategic goals here is by partnering with businesses like Boeing. Okay, they've just agreed to purchase 100 737-10 aircrafts and potentially 30 more. Now, these deliveries are going to start to begin in 2025, and the main benefit that they're going to have is improved fuel efficiency. Okay, that's going to be huge, especially if they can save on those costs. Their profit margins will benefit from that, and as well, well, they'll be able to put more premium seating in these planes, which again will generate more profits for them. So I'm eager to see how this actually works out for Delta, because this might be a great investing opportunity. Now let's jump into this consolidated statement of operations. We'll start here with our operating revenue. We have passenger revenues of 11.4 billion. Again, this is record revenues, so it just beats out their 2019 revenues by 54 million, but no true growth there. Then they have their cargo revenues. This actually has been growing, and now it's up 27% from 2019 levels. And then the same thing with their other revenue. This is up to 2.2 billion now. So far we're definitely able to see that, especially once we see a rebound in the economy, people start to travel more. This is a business that may actually make good on their promises to their investors and to meet their strategic goals here. Anyways, it leads to 13.9, let's call it $14 billion in total operating revenue. Now here's where the kicker is, okay? As I previously alluded to, they have had a lot of expenses and a lot more costs now that have been incurred on the business, and it's dragging down the bottom line. As you can see, aircraft fuel up 50% from 2019 levels, and when we add up all the total operating expenses of 12.5 billion, we're left with operating income here of 1.5 billion, let's call it. And this ultimately is down 30% from where they were in 2019. And ultimately this can actually be seen as a good thing, because they were still able to produce 70% of what they could in 2019 with a lot more expenses, at least to this third quarter. And then we can compare this to the 9 months total. We're actually down 60%, let's call it, from the 2019 levels. But again, we have to understand as investors, there may still be an opportunity here. Just because these results may seem bad, we have to have a long-term perspective here and understand once fuel costs start to come down and some of their higher ticket expenses start to decrease, their profits are going to definitely benefit from that. And you have to be able to recognize that and take advantage of that before it happens, because the share price will appreciate by then. With that being said, let's jump into the balance sheet here. They have about $8.3 billion in cash when we add up their cash and short-term investments. We compare that to their debt figures here, $2 billion in current debt and then $21 billion in long-term debt. Add that together, about $23.2 billion on the $8 billion in cash. That doesn't look amazing, and they recognize that, and that's why they're trying to decrease that debt level that they do currently have on hand. As you can see, their cash positions were declining, but that's also because their debt figures were also declining, and they were spending some cash on debt and some other things. Obviously, since 2019, we can see some things have changed here, but we can see that they are committed to repaying down that debt. As you can see, $1.8 billion of debt was repaid during this quarter, and so far year to date, they've paid down more than $4 billion in debt. So that's a great thing to see, that they are already acting on their strategic initiatives. They remain committed to strengthening their balance sheet, again targeting that net debt of $15 billion by 2024. Now we'll jump into our statement of cash flows here. We bring down our 3 months ended net income here, $695 million. Add back in our non-cash costs, we're left with $869 million in cash from operations. Deduct our capex, and well, yeah, we're not left with much, and that's why they're using some cash to pay down some more debt, this $1.8 billion that we already discussed. Share buybacks have stopped since 2019, and same thing with their dividend, so we'll touch on that in just a second. Just to reiterate, we are looking at $7 in 2024 in earnings per share and $4 billion in free cash flow, as well as a debt to EBITDA ratio of 2 to 3. So keep this in mind when we get to our calculator. For right now, analysts are expecting that by the end of the year, they can come in with about $2.80, let's call it, per share in EPS. So if we plug that figure into our calculator and we assume that for the next 10 years, they can grow at 5% on a 20 PE, the stock should be worth about $36 per share on an average basis. Right now, it's trading at $31 per share. So this might actually be a great time to buy. Now, in the best case scenario, let's say that they can start to grow at 10% from the levels that they're currently at for the next 5 years, and then that drops down to 5% for the 5 years after that. On a 25 PE, the stock will be trading at $60 per share almost. So again, nice stock appreciation. And then in the very worst case scenario, let's say they're not able to reach the growth metrics that they're trying to, they're not able to grow at all for the next 10 years, very unlikely on a 20 PE, the stock would be worth $23 per share. Now, if they actually are able to get to $7 in EPS by 2024, let's rework these calculations. And as you can see, on an average scenario here where they're growing 5% each year, for the next 10 years, they'd be worth $92 per share. If they can actually accelerate that growth, $145 per share in the best case scenario. And then in the worst case scenario, they'd be worth $60 per share for a margin of safety investment. And this is why you really need to take care with the investing decision here for Delta Airlines. Do your own research, do your own due diligence. In my opinion, this may be a great buy, especially if they can come in and reinstate that dividend. We'll see what that does to the calculation. Yeah, it's really going to take off from there. But we have to also understand airline stocks are subject to volatility. They're always always some of the first stocks to get hit hard, especially when things impact the economy. Airline stocks are the very first to get knocked down. So you have to take all that into consideration when it comes to investing in this kind of business. But I can tell you, especially if they're able to achieve the strategic initiatives that they're trying to, increase their earnings per share metrics, reduce the debt that they have on the balance sheet, improve their margins, etc. I mean, this is going to be a business that I really do like. And at these levels, it would be an absolute steal, especially if they start to reinstate the dividend that they used to have in there, start doing some share buybacks, etc. Yeah, this might be a great buy here. But again, please do your own due diligence and research. That's all for my analysis. If you made it this far in the video, please like and subscribe. It helps with the channel greatly, and I'll see you on the next one.